Welcome to Dollars and Cents, understanding your small business's financial statements presented by the North Central Small Business Development Center at Central Lakes College. In this on-demand training, we will equip you with the essential knowledge and skills to better understand your small business financial statements. In Chapter 2, you will learn how to use the statements to set growth goals. Whether you're a new entrepreneur or a seasoned small business owner, you will be able to directly apply the concepts learned today to your business. Hello, my name is Tyler Whitwer, and I am a consultant with North Central SBDC. Chapter 2, how to use these financial statements to set growth goals. Setting growth goals for your business based on the financial statements gives you a solid foundation for what your company can truly achieve in relation to what your goals are for the company. Profit and loss. Using the income statement for setting goals and budgeting for future growth is something that can be extremely beneficial for a company. This approach works best when you have some historical data to work from, and when you have a few years of solid data, it can be really beneficial to compare specific time periods to determine your variance in expenses and income on a month-to-month or annual basis. If we use the example from Chapter 1 and we set a goal of increase in sales by 15% over year-end 2022, we could look at the income statement and figure we need to find a way to sell an additional $20,250 in product or inventory over the next year. Setting a goal as broad as increasing sales by 15% leaves the how-to up in the air with a lot of options. Assuming you have a full year's worth of income statements, you could take the quarterly statements and plan based on how you performed each quarter in the prior year. This will give you a good starting point on where your sales flowed throughout this year, giving you an idea of what percent you'll need to increase sales per quarter to reach your goal. Another way to use the income statement is to look at ways to decrease your expenses or liabilities. You can look at the annual statement and see how much money you spent on utilities, marketing, insurance, rent, software, and other things. Once you pick out an area that you believe can decrease the expenses, like marketing or insurance, you can then shop around for new insurance plans or maybe new software. If you are being diligent about how much you are spending on expenses, you will find some unnecessary ones that you can cut out to increase your bottom line. If you use the example here and we look at year-end 2022 and year-end 2021, we'll see that there was an increase of approximately 13% in sales year over year. There was also only an increase of about 6% in cost of goods sold, which drove the gross profit year over year up by almost 16%. This is a great example of increasing revenue while maintaining a good margin, and actually a better margin than the prior year. Next, let's look at the expenses from year-end 2021 and year-end 2022. You'll see that the utilities, office supplies and software, and operating supplies have remained the same. However, they made a decision to reduce their marketing budget back to the same level from year-end 2020 and were able to once again increase their margin by lowering costs. This is an example of how you can use your statements to make business decisions. In 2021, they increased their marketing budget and made about 4% more revenue over 2020. So it appears they put their effort into marketing at a lower price point and were able to increase their revenue, decrease their expenses, and ultimately increase profits. And now let's talk about the balance sheet. The balance sheet is used to determine a company's value at a given point in time and can also be used to determine if a company is thriving or failing. Since that's the case, you will typically be asked to provide a balance sheet with any sort of financing request so the creditors can see that you have assets or income to back up a purchase. You will be able to create a projected balance sheet once you have some historical data. To do this, you will create an initial or current balance sheet to work off of. Next, you will gather the historical data. 2 years worth is going to be a good starting point and will likely allow for reasonably accurate predictions. Once you've reviewed your past data to see what assets and liabilities are consistent and what have been paid off or cashed out, you'll be able to put together a projected balance sheet. You'll first project your fixed assets, as these are typically tangible and more long-term since the business normally uses these. Think vehicles and production machinery. These assets will incur depreciation over time, so be sure to account for that accurately in the projection. Next, you will estimate the company's debts. This is pretty straightforward, as you will be able to project based on the prior year's debts. You can use the debts you still owe and pay over the projection period and will be able to reflect when these will be completely paid off. You would also want to include any new debts you plan on taking on throughout the projection period. Lastly, you will forecast your equity. To do this, you will review the equity over the last 2 years to calculate the company's net income, account for your dividends, and add in any changes in equity. Once you're able to accurately project equity, You're estimating the earnings for the business and can pass that along to stakeholders and investors for future investment opportunities. Using this example and looking at year-end 2022, we will walk through these steps. As you can see, there is a consistent fixed asset of $100,000 on all three of the balance sheets prior, so you would start there and add in any planned purchases for the next year. Next, with the company's debts, we can estimate that there will be approximately $8,000 to $10,000 less on the long-term debt section. So let's say there will be $76,000 in year-end 2023. Once again, we'd add in any purchases that are planned for the next year here too. Then lastly, we'd look at the equity on the business. It has steadily grown after the debt has been paid off and assets increase, so we could approximate owner's equity of about $52,000 based on prior year's increase. And now cash flow. A cash flow statement can be used to set growth goals because it is measuring the net cash in and out of a company over a specific period. This is extremely important to understand when you have a cyclical or seasonal business. You'll plan for growth based on when you have more cash flow. Knowing the cash flow you have on a monthly or quarterly basis will help you plan out your whole year or even further. If you know that you make 75% of your income in quarters 2 and 3, then you'll be able to see the amount that you'll need to save in order to float quarters 1 and 4. On the flip side, you'll also be able to see the money going out of your business and can use that to determine if you need to change your spending or overhead to achieve the desired cash flow level. If you were to forecast using a cash flow statement, you would set a projection period. As I stated earlier, it could be a month, quarter, or year, and then determine all of your income. My personal preference would be to project for the following 1 to 3 months. This can really help you see the full picture of how much cash you will have for upcoming events and projects. You will need to list all of your incoming cash from sales. This should be based on past experience with customers or with a year or two of past statements. You will also include non-sale income such as tax refunds, grants, investments from shareholders or owners, royalties, refunds, etc. Next, you're going to look at your outgoing cash. This will be your normal business expenses plus any additional special assessments that may be coming up. Think property taxes, that's a good example. Example of outgoing cash would be rent, payroll, raw materials, assets, bank loans, fees and charges, marketing and advertising, or tax bills. Once you've added up each of your incoming and outgoing cash payments, you'll be able to determine if you have a negative or positive cash flow. A negative cash flow from week to week can certainly happen, but staying in the positive will obviously be the goal. Using this information and knowledge of your own business will allow you to see even week to week how you are doing, and it can help tremendously in your projections and future goals. Using this example, you can see that cash flows can have quite different effects based on your actual business habits. If we look at year-end 2021 and year-end 2022, there's a substantial difference in income and total cash from operating. However, the actual cash available is significantly different, but not as much as you expect from just the net income numbers. You see that in year 2022, there was quite a bit of cash from investing activities going on, which of course takes a toll on cash available. Now, this increase in sales from year-end 2022 could be due to the investment in more equipment, and then forecasting for the following year could mean much more cash available because the equipment was already purchased. The equipment and furniture purchase could also be because the useful life of the old equipment had come to an end. In this case, forecasting and planning are important when the expenses are coming up. Now let's talk about SMART goals. When setting your goals, it is fine to start with a broad statement like, I want to increase my profits. But then you need to come up with a way to reach those goals. This is where the SMART goal system comes into play. SMART stands for specific, measurable, attainable, realistic, and timely. Here we will break that down. So our goal is we want to increase profits. Specifically, I will increase our revenue while cutting down on expenses. Cutting down on expenses may be in the form of renegotiating rent, pricing new vendors, or even as simple as using less electricity or office supplies. Measurable. I will be able to increase sales by using social media for free marketing to reach more people and drive revenue over the busy months. Attainable. I will improve customer relationships to ensure repeat business and good word-of-mouth reputation, which will help drive sales at a low to no cost. Relevant. By utilizing the lower or no-cost marketing methods, any additional sales will increase the profit margin due to the minimal cost of driving sales. Timely. I will do this over the next quarter. We hope that Dollars and Cents has left you with a greater understanding of how to read and use your small business financial statements. If you'd like to continue your learning and meet with a North Central Small Business Development Center consultant, visit the website below or call our regional director. Dollars and Cents, Understanding Your Small Business Financial Statements is presented by the North Central Small Business Development Center at Central Lakes College. The North Central Small Business Development Center is a part of the Minnesota SBDC network. This video is funded by a grant from the Minnesota Department of Employment and Economic Development.